discussing Asia's financial architecture. Let me start with a brief introduction of myself, Andrew Cainey, your moderator for this session. I am the project director for the Asia Finance project with Fung Global Institute. I first came to Asia to live and work just over 15 years ago in the spring leading up to the Asian crisis of 1997, initially in Korea, now much of the past many years in China, and have seen really the twin themes we've been talking about. How can the financial sector, how can the financial architecture serve the needs of the real economy, and yet also continue to keep learned, as it were, not forget the lessons of the Asian financial crisis and withstand risks, whether they come from within Asia itself or indeed from the rest of the world, as some of the panel thought on earlier. Our theme now is trade finance, and I'll come to our esteemed and experienced panel in a moment to talk much more about trade finance. But just a few words about where we are. This is a panel discussion, but actually it's a bit more than that. We started working on trade finance back in January as the first real initiative within our finance research program. And the way we're doing that reflects the engagement and dialogue that we talked about with Professor Spence earlier this morning. That is to bring together practitioners from business, leading academics, leading policymakers, all together to really understand the issues and then to work through recommendations and solutions in a very interactive way. So we've had some of that dialogue already. We'd like to continue that dialogue today and share where we are with the research, but very much get your reactions and inputs to that. On the panel today, we have, starting farthest away from myself, Rakesh Bhatia, who's the Global Head of Trade and Supply Chain for HSBC. Clearly brings very deep practical experience of how the trade financing is working, the opportunities and the challenges. Then Edelmann, who's a partner of Oliver Wyman Consulting, a lot of experience in trade finance and been very helpful in working with us on understanding the data and the issues and then potential options. Dr. Changyong Rhee, currently Chief Economist with the Asian Development Bank, who brings a very broad Pan-Asian perspective, but in prior roles also has very good policy experience within Korea and indeed in the banking sector in Korea. And finally, of course, Andrew Sheng, who I think needs no introduction as president of the Fung Global Institute. So with that, I'd like to hand across to Andrew, maybe to talk initially about, so why are we talking about trade finance now? In many ways, we could have started the Asia Finance project, and we've chosen trade finance.
Thank you very much. I'm really delighted here. These are, on the right-hand side, our partners in this work. And let me say why we chose trade finance. Now, the thing, you've heard this theme over the last 2 days. Finance must serve the real sector. Banks started as trade banks. Let's remember this. They were exchange banks. They were trade banks. They financed the trade, right? And today they've evolved, into the derivative area where they do make a lot of money. But, we must never forget that trade is what keeps the world go around. We exchange goods and services, and the banks, help finance that. That's a lifeblood of the whole issue. So it reflects our, what I really want to describe here in the next, 10 minutes is why do we choose this? Because, when we started thinking about the new Asian financial architecture, it was very clear when the crisis happened. The thing that failed, Asian banks and fund managers didn't buy that much toxic assets, but we got killed through the trade channel, right? I mean, peak to trough, GDP dropped, up to 10% of GDP for some countries. Trade dropped 20%. Trade finance dropped 20%. Now that was the one that was a killer because once the trade slowed down, and Asia is a major trade engine and manufacturing engine, the trade stops. It was reputed in China as many as people, 20 million people, started losing their jobs. And luckily, the prime pumping that occurred, brought this back. But the trade finance happened because Lehman Brothers, which was not that much involved in trade, collapsed. That stopped the counterparty transactions at the wholesale level, that means the banks won't clear. And then they run off the trade finance because trade finance is only 120, 140 days in the area. So guess what happened? 10 years later, it's three years later, the major reforms, have it addressed trade finance? Hello, Basel rules says trade finance should have a risk weight higher than before. Hey, we didn't cause this. If I'm a trade guy, I would say we didn't cause this problem. How come we end up paying for it, right? And a lot of the attention was even much more on fixing the derivative side. But the whole of Asia, experts like Rakesh, or Bhatia and Dr. Rhee, who will tell you the thick of this, very clearly, has understood that this is the area where Asia cares about. Now, why then is trade finance so critical for all of us? Well, trade finance is part of the supply chain. Point number one. Trade finance is the linkage. There are the bank trade finance and then the supplier trade finance side. They are the linkage between the multinationals and the SMEs, right? And so if that trade finance breaks, right, the SMEs immediately lose confidence, lose the orders, and lose the jobs. So it very clearly, trade finance is at the heart of financial reform. So we looked at that. Now, very clearly also, if we allow finance to have that volatility, which is exactly the point that Mike Spence was talking about, stability is actually a great public good. Okay? So maybe what we should think about is to actually isolate, ring-fence trade finance. That's what our project was called. How do we ring-fence trade finance? So that, okay, you guys, gamble all you want, you collapse all you want, but let the trade finance flow. Okay? And another illustration from the lessons of this crisis. You have got to have a living will. What's a living will? Living will says that if I collapse, I need to know, what I wind down. First thing I wind down is my trade finance. Because that is the lowest, the fastest to run off. Okay, and if I run that off again, jobs will be hurt. The whole engine will be there. So we do need to think very clearly. I don't want to go into the regulatory side and how we fix this, but I just want to give you first an overview. Now, that overview comes from a very important point that I've been trying to figure out about the way the world works. Finance is a network. Supply chain is a network. Okay? And within networks, there are huge feedback mechanisms that we haven't fully understood. So we've looked at the world in terms of silos. We look at each our specialist area, and we forget. Now, trade finance has been a little bit like Cinderella. It's been taken for granted. And the reason why nobody pays that much attention to this is very straightforward. In the old days, the trade finance is the banker that rises to the top. Today is the trader. I'm not to the trader, the FX trader or the markets trader. So that priority is very important. So in the study, as we got the numbers out, it became very clear what is the ROE on financing trade finance? 5%. What is ROE on proprietary trading in FX, equities, etc.? 20% upwards. So are you surprised that the big players are now moving their best resources, their best people into these, what I personally call the riskier side of it, and less helping the real side? But we are exactly in what I call the Ford moment. Ford started paying his workers better. Why did he do that? Because he says, when I pay them better, they buy my cars. Trade finance is the same issue. You help the SMEs grow, society prospers, and that's what we need to do. Now, given that we're talking about systems, what the FGI methodology is not just to look at the macro side, which is very often the economist, the policymaker, but we really need to figure out what is it stopping the system, and that's what I call the ground level, the micro. What is it that the micro doesn't happen? So it's not just about the top down. Again, I go back to Mike Spence's view. It is about bottom up, and it is the feedback interaction between the two that ultimately determine where the risks are, right? And so what has happened before was that policies didn't understand the micro, and the micro guys didn't understand what the policy was all about. And so the policy translation is problematic. The outcome of policies don't get what they want. And the present set of rules very clearly determine that. Now, very, very quickly, to sum up, what we try in FGI in terms of methodology, why we selected trade finance, is what I call system acupuncture. 20, 30 years ago, acupuncture is still kind of voodoo science. Today, they realize acupuncture is very important. It links up, the qi or the nerve system. But if you put the needle at the right place at the right time, the system either self-heals or actually begins to change. Trade finance is exactly like that. It's a sort of a network that you take for granted. After you take them for granted, you see them, right? Or you don't see them. And then, but if you work at it, you'll be able to make that change. So from this, I think all my colleagues here, we're very grateful to all of them for being our partners in this project. And they bring insights to it that I never had before, and I'm sort of still learning on this issue. But we hope that you will be able to see how we approach it, that we review for you from a case study what the major policy issues are. Thank you.
Andrew, thank you for that perspective. I like it very much in that spirit. I have to turn to Rakesh to bring both the perspective of what this means for HSBC's customers and for HSBC as a business. What are the opportunities, what are the challenges, so that we can continue this dialogue.
Thank you, Andrew. I think the way we see it today is that there are sort of three very key aspects which are impacting not just HSBC, but the world trade and the trade finance industry. I think the first is the current business environment. The second is the developing regulatory regime around banking in general and trade finance in particular. And the third is the currency issue. And I'll talk a little bit about all three of them just before I talk more about what we are seeing in our business. I think in terms of the business environment, the US has been anemic for almost 3 years or so. And just yesterday, I think they revised their first quarter GDP growth rate downwards, so it's still, limping. Europe, the problems are very well known, and they're only getting worse right now. And Europe is the largest trading bloc of the world. So if Europe is slow, the world trade automatically slows. China, for the 7th month in a row, the PMI is below 50, indicates a contraction, and that's a source of concern. And we've seen India released its GDP growth figures yesterday, and they were the lowest in, I think, about 9 years or so. So a lot of the engines or big constants of world trade are actually really slow at this point of time. And that has a tremendous impact on the overall trade, which impacts growth, which impacts jobs, which impacts prosperity. Some of the things Mr. Sheng was talking about. The second issue is the developing global regulatory regime. And Basel III clearly is actually not necessarily singling out trade to come out with regulations which are going to be tough, but it is actually not giving trade finance any specialist or preferential treatment the way Basel II gave. And that is what is creating the problem, that all products of banks are being treated with the same brush. And that's where Mr. Sheng was talking about derivatives and trade finance requiring a similar level of capital, similar level of liquidity, and similar level of leverage in terms of the ratios. And that's clearly a problem. The interesting aspect of that is that it's debatable at this point of time whether US will follow Basel III norms. European Commission and European Parliament have just signed off that the actual implementation would be a lot more dilutive than the global Basel III norms being suggested. So whether it is in leverage, whether it is in liquidity, whether it is in some of the other aspects of Basel III implications, it will be much more dilutive as applied to Europe than at the Basel III level. So there is a real risk that there is a possibility of almost regulatory arbitrage, where Asia, not having a common voice, is exposed to Basel III at the toughest level, and the other two big trading blocs of Europe and US are not subjected to it. And that's a big risk for Asia, which incidentally, and there's an Oliver Wyman report which says that by 2020, 60% of global trade will have an Asian leg. So the largest trading bloc will be following the toughest regulatory norms for trade finance. And that's a very negative from where we sit and evaluate it. And the third thing I wanted to mention about was the currency. I think almost 85% of global trade is in US dollars, 7% or so in euro, and 4% in RMB. And 50% of that RMB is UK, is Hong Kong and China, and 20% in Singapore and China. So the shortage of US dollars, which is now a common theme, particularly in the European banking system and in Asia to a large extent, will continue to impact the ability of non-US banks to fund trade finance. And therefore there is a real need to actually diversify some of the sources of funding and move into different currencies, RMB being one of the major ones that we should be looking more and more towards for participating in the world trade. And specifically the intra-Asia trade should be more and more focused on RMB. So that's some of the things that we are seeing from a global perspective. From our own perspective, we are the largest trade bank. We have about 9% share, and last year the total transaction which went through us was about $500 billion. And we are actually proud to say that we would be probably the sort of largest supply chain banker of the world, linking a exporter in Bangladesh to Walmart in US. But we see that we have to do a number of things to keep on developing in what is required by the market. I think the issues around the European banks and the deleveraging by the French banks and the other European banks have created a real issue in the commodity and structured trade space. So that's one area where we see real demand coming through. The other is on receivable financing and open account. There is a lot of opportunity that is coming through in terms of financing what was earlier done on direct trade. As the risk increases in the market, as new supply chain lines develop, the requirement for trade finance increases, either through the open account channel or through conventional trade channels. And the last bit where we see a big role for HSBC going forward is to work with financial institutions globally, because in a number of countries in the world, we are not directly represented, but those countries participate in world trade, and we want to work with financial institutions there to actually push the global trade in those countries. So that's how we see things go.
Thank you very much, Rakesh. Let me move along now to Dr. Rhee and get his perspective from his experience working with ADB in Korea.
Thanks very much. It's my honor to be here. Thanks, Andrew, for inviting me here. Actually, I fully share the importance of trade financing, as Andrew just mentioned and Rakesh just mentioned. But on the other hand, the last couple of months, when I traveled to the academic society and the other region, I'd rather say that there's still a controversy. It's whether the trade financing is important is still controversial. And they showed data in 2008 and 9. They agreed that the trade really plummeted. But whether the trade financing, the lack of trade financing was the real cause of this big drop of trade, they believe is still controversial. They show some data in every region. that the decrease of the trade volume is larger than the decrease of the trade financing volume. And that is cited as evidence against the importance of trade financing. And some micro study shows that the SMEs and companies with low credit rating and their trade financing volume hasn't decreased much more than the other the high credit rating companies. That evidence is also cited as an evidence against the importance of trade financing. And one example is, I think World Bank publication is quite nuanced, but if you read it, their book, it says that still the jury is out, rather than concluding that trade financing is very important, which is really against what I feel in Asia, and especially when I was a government officer in Korea in charge of trade financing and financial matters. After 2008 crisis, the first turmoil and the first cry from businessmen and in the market was to secure the trade financing. So, but I was also a former academic. I was also a former the professor who believes regression result. So I'm at an imbalance in some sense. Academics still say that the jury is out. On the other hand, my real experience saying that trade finance is very important. So I thought about why there is a discrepancy. I think data. So that's why I want to emphasize that in your study, the data is a key. At this moment, most of the evidence focus only on mostly the letter of credit. And when they say that the decrease of trade financing, they focus on the bank intermediate letter of credit. But on the other hand, trade financing has a full value chain, right? From the pre-shipping and shipping and to the delivery to all the destination. So there is no comprehensive data set yet to cover whole the trade financing channel. So that's one thing. The other thing is that anecdotally we know that more than 80% of the trade financing is usually non-bank intermediate. It's credit each other for supply and demand. And when the crisis happens, usually the company which rely on to their counterpart may be shut off from this credit line chain. Then they have to apply for the bank credit. But on the other hand, bank is not willing to lend their money during the time crisis. But this kind of demand-supply gap, I think, won't be captured by the statistics gathered by the bank, because previously those companies are not in their data set. And the third, I think, reason may be trade financing, as Andrew mentioned, the maturity is very short. So, but in the 2008-2009 global finance crisis, G20 and all this, because of the expansionary monetary policy, after 2 quarters later, the global economy had a V-shaped recovery, and we are back to the normal track. In some sense, maybe the 2008-09 crisis period, using quarterly data or semi-annual data, may not capture the severity of the drought of trade financing. So there are many reasons the data is kind of ambiguous. That's why I really, actually rely more on, when I make a judgment, rely on more practical evidence. For example, ADB, from 2008, we start to trade financing guarantee program. And 2009 alone, the growth rate of this trade financing facility guarantee program was about 240%. So we can see enormous increase of demand from the low-income countries. That is, I believe, is indirect evidence of the importance of trade financing. In Korea, when Lehman Brothers collapsed from August to September and October, all the businessmen come to my office, say that now it's a big problem. I have all LC and I have all the pipeline things, but there's no trade financing available. And please give us some dollar. You have 240 billion reserves. Why don't you give us some money? But at the time, as a Korean government officers, we cannot use that very effectively, freely, because we don't know how long is this thing's gonna continue. If you know that, if you knew in advance that global economy will have a V-shaped recovery, we could have used it. But given that we don't know how long it's gonna last, at the time we are very careful, and we don't want to also give the money through the exchange rate market, because then we cannot differentiate speculators versus real trade finance demand. That's why Korea government decided to provide trade financing through the non-exchange market. So that means the domestic, the exchange, the currency market. So through the Korea Exchange XM Bank, we provide dollar to the company, which actually shows us some evidence of trade financing. So there are many indirect evidence that really shows the importance of the trade financing, but the most important research topic may be how we can get the most systematic data, which can convince the many people that trade financing is very important. And especially, you mentioned the regulations, so I think the impact of this Basel III kind of evidence is very important. So let me just conclude with what to do then. I think let's assume that we have data and we can persuade that trade financing is important. First thing, the immediate concern is what Rakesh just mentioned, the change of Basel III. And I understand the Basel's argument. So it's important to penalize the speculative transactions. But on the other hand, it's important to avoid good financial transactions, such as Andrew mentioned, trade financing. So I strongly believe that it's much better to allow 20% credit conversion factors for trade financing as in Basel III, rather than increasing to 100%, so increasing the cost of capital by 5 times. So I think the Asian countries must have a unique voice, one voice, to emphasize that at least for the trade financing, they have to apply the Basel II's 20% credit conversion factor. That's very important. And I mean, there can be many things, but from a policy point of view, I think another important one is the role of the some MDB, regional bank like ADB or the CMIM, which we just created, Shanghai Multilateralization Initiative Multilateralization. Their problem of CMIM is still the total amount of capital is increased to 240, and doubled basically. But on the other hand, it's just a pledge. They don't have the money. So actually, then it's a bilateral swap. When something bad happens, then if it's it's an individual shock where some other countries can help others, it may be effective. On the other hand, if it's a global shock, such as Eurozone turmoil, every country will be affected. I doubt it which Asian country will lend the money to each other. So it's much important to have a fully funded system like IMF to make CMIM effective. And if we have a fully funded system, maybe the first step is to use this money to guarantee the trade finance. So using this as a guarantee. One problem, ADB actually doing this credit guarantee for the trade financing, but internally the problem is that this guarantee has the risk weight as 100%, same as a loan, which is kind of silly, but so it's internal regulation. So I think this kind of things has to change. Otherwise, the trade financing and the guarantee program for trade financing may not be effective. So if you believe trade financing is short-term and less risky than other loans, the guarantee on trade financing also has to have a less capital burden in doing it. Finally, I think the most important thing is for Asia, trade financing is in international currency denominated terms rather than own currency. For US and Euro countries, when each country is just using expansionary domestic monetary policy, that can actually act as a counter-cyclical policy as well as solve the trade financing problem. But on the other hand, in Asia, even though we do the lots of domestic expansionary policy, it won't help the trade financing in terms of dollar. And so how to secure that? In some sense, I think there are lots of things that Asian policymakers can do, especially by expanding this bilateral trade settlement system between Hong Kong and China that can be applied for other Asian countries. And it really depends on the central bank's willingness to do it. And if they do it, then they will definitely reduce the dependence on the dollar or euro, and then trade financing can be effectively dealt within the region, and that is a great step to start with. Thank you.
Thank you, Dr. Rhee. The many topics are very, very high relevance to this discussion on how to both ring-fence trade finance and to make sure there's the right trade finance to support Asia's growth. Maybe finally I turn to Christian to discuss some of the findings of the work we've been doing together with his support and the Wyman support on trade finance and some potential options for improving the situation, particularly around ring-fencing.
Thank you, Andrew. And before going into the potential solutions, let me just add a couple of more points around the discussion that we've had on the macroeconomic importance of trade and trade finance for Asia. I think Andrew had a very good point at the beginning that trade is really a network product. And when you look at it across Asian trade flows, 80% of these trade flows, at least once in the life cycle across these networks, require at least one form of financing or risk mitigation, and risk mitigation also including credit insurance and other products. I think that underlines the strategic importance. If anything breaks down in that long value chain, it will have an impact on the real economy. And also when you compare the trade statistics, and just take one other one, Rakesh mentioned the 60% share of Asia's share of global trade flows. When you compare trade over GDP, Asia on average is about a factor of 3 to the mature economies. So again, that shows the strategic importance for trade finance for Asia. Secondly, I think the Basel topic is very interesting, and we discussed that at length